Oh man, what a day! Whew, what a day. All right, today is what, Wednesday? Yeah, Wednesday, May 21st. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is basically the same, but I kept some core weave short, which maybe I'll regret. Maybe I won't. Who knows? Depends a little bit on the market. Speaking of the market, we got smizzoked today. So, including the market trading down about 50 cents after hours, we're down 1.75% for the S&P. The Nasdaq's down 1.5%. The IWM is down almost 3%, 2.75%. The Russell just really eating it. It tends to be the index that is the most interest rate sensitive. TLT off almost 2%. A bit of a disaster here. We'll circle back on that, talk about that more in a minute. Gold finished positive. Bitcoin. Come every time I go to type up Bitcoin in the afternoon meeting, I get a lag on the symbol. Bitcoin, there it is. Bitcoin finished green. Interesting. Bitcoin holds up again. I'll tell you, this Bitcoin, I think, in my opinion, has really done some proving of itself over the course of the last month since those April lows. I've been a big critic of crypto in the past. No one's been able to make an appropriate use case to me. And recently, as we see a rotation out of U.S. exceptionalism, people don't want to own the dollar. They don't want to own bonds. More and more people are buying crypto. So it's really starting to act as a safe haven, as I guess it was supposed to originally. How did oil finish today? Because it was up pre-market and then finished down, got smoked down. Okay, so let's take a look. Yeah, so the market, oh man, what a day today. So we gapped down this morning, and the bid was there. The bid that never goes away was there. You can see it in the SPYs. You can really see it in the Qs. And that was despite the TLT gapping below that key 85, which was disproportionately impacting the IWM. So the Russell really didn't bounce this morning at all with the TLT down that much. But that never-ending bid in this market really lifted these QQQ names, really lifted the semiconductors. NVIDIA made new recent highs today. Not many stocks were able to do that. Google was on fire at certain points today. It was all about these Mag 7 stocks. Qs, huge bid, filled the gap, consolidated, broke out of that consolidation to the upside, was continuing to grind higher. And then at 1 o'clock, we had our treasury auction that was a bit of a disaster. And the TLT, which I was already signaling is a real problem here below 85. 85 is this huge level we keep talking about with the TLT. Low from January, low from April. We tried to defend it a few different times in the month of May. Was already trading below that key 85 just to then get smoked on that auction. So this went down further, and finally the market really began to notice. Huge turnaround in the Qs. Qs were basically testing the breakout level. It's 522, 522.50. High of the day is 523 today. So I guess we actually even got new highs in the Qs. So we're really testing that breakout level. And yeah, I mean, finally something happened that was able to hit the market down. The question is how sustained can it be? We do still know that our never-ending bid is really around for the remainder of this week, but what we need to keep in mind about systematic flows is that it's just one cohort of the market. So it can be overwhelmed. if there's enough selling coming from other places of the market, it can overwhelm a corporate buyback bid, it can overwhelm a CTA bid, and that is what happened in the afternoon session today. The question is, can it continue? Can it give further downside? And that's to be seen. We closed at our ADMA on the daily chart. It seemed like that ADMA on the daily chart was trying to provide some buying and some support here around this 514 on that first test, though we ended up kind of breaking below that. So we closed, I think, just below the ADMA on the daily chart for the Qs. I think the SPYs are a good bit below it. The IWM obviously leading the market down. The IWM here has almost filled the gap, believe it or not, of a week ago Monday, the China-US tariff pause gap up. So you can really see the weakness in the Russell. And again, the question is, what kind of follow through, if any, do we get? There's definitely room here technically for this market to pull back further. Again, all the Qs and SPYs did was really get down to the ADMA, just the upper band of equilibrium. We've noted that the space between the 8 and 21 EMA is widening. You could easily get a move back to 505 in the Qs and have them still be healthy. You get a pullback to 500 or even below 500 and have the Qs still be healthy. The market still looks very healthy. Pretty much the same deal with the SPYs. Can easily pull back and find some support at 580. The low from the China pause day is 577. Could easily retest 577 to 580 and still have the market looking healthy. 570 is a huge level for the SPYs. You could test 570, have previous resistance hold as future support, and then create a pivot low. 570 has really been the line in the sand level that I've been talking about. So if we're able to get down there, it's still $13 lower. That's, I think, the do or die spot for bulls to hold. But as long as we're above SPY 570, the market looks healthy, at least on the surface of things, at least until you look at the bond market, which doesn't look healthy, at least until you look at the IWM, which is more influenced by interest rates. And I would say even at this point, it doesn't look unhealthy, but if this gets below 200 with that relative weakness, that one is starting to show a failure as well. So yeah, I mean, just incredible how we got bought up again this morning, just to then have another event hit. This market's done a fantastic job shrugging off any negative news still, but it's like I said in an afternoon meeting recently, this stuff matters until all of a sudden it doesn't. So we'll see on that. What else? I don't really have too much else. I mean, we can take a quick look at some charts. Apple ended up giving that inside and down. I do not think that Apple looks very good right now. NVIDIA pulled back to the ADM and the daily. Also still looks very healthy. It could pull back to 125 and still look healthy. Semiconductors have just been on fire. But this did break highs and fail, so that's notable. Tesla, after a double failed breakout above 350 yesterday, pulled back to the ADMA on the daily today. There's another one. Could easily pull back to 320 and still look healthy. The market's gone so far so fast that all we're dealing with most of these names right now is not broken charts. It's price corrections of extension. So it's just continues to be a crazy market. And then this CoreWeave, oh man. So new highest volume ever for CoreWeave. It's a day 4 to the upside. This daily chart really looks like it's beginning to go parabolic. But this bid was relentless. This bid was relentless. I really thought that I had it here, and I did have it. I was able to cover a lot of stock into this down move on this CoreWeave. I could not believe that this thing got back above 105. I remember watching this really closely, seeing the market starting to kind of get hit a little bit, but watching this thing riding this ADMA. I'm like, okay, it's good we broke the ADMA, and guess what? They're trying to hold the 21 EMA. We get an inside and down, and I'm just like, if I can get this thing below 105, I think that that'll really trigger renewed selling to come into the stock. And that happened. It got below 105. We very quickly got down to below 101, retested 100. And a bounce back makes sense, but this was more than a bounce back. This was a full recapturing of those levels. And then we saw it into the close as well. Just an incredibly strong buyer in this CoreWeave. I don't know who's buying at this price point, to be honest. Like, I get being a bull on the stock, and at points in the past, when it IPO'd, I certainly was bullish on the stock. Seeing this thing, especially because we're not at the increased tradable float from a lockup yet, you know, break out and start to squeeze higher makes sense. But on a day four to the upside, who's buying this thing at $107 aggressively? Someone is. I don't know who. Really curious if that's a short seller that is just totally screwed, or if that is new buying that's still coming in. I'd be inclined to think it's just a very, very stuck short seller at this point, because you are chasing price big time at these prices. But you got to be especially careful shorting these recent IPOs, because that tradable float is still light, and that's when they can squeeze. And you could probably make an argument that the stock even belongs at these prices, but I would also make an argument that markets work in periods of expansion and consolidation over time, and when you extend this far this fast, you're typically due for some degree of a correction through time or price. So that was an interesting one. What else? I traded a little bit of this ASST to the short side at one point this morning. Kind of scalpy, made a couple dollars on it, got out of the way. I got all out of that wolf that was called out after the afternoon meeting yesterday by Pat. Thank you, Pat, for the money. I was able to short above $2. I got out below $1 today, so that was a real win. So yeah, great stuff there. And I think that's all that I got. A lot of moving parts, so of course, happy to answer any questions that you guys might have. We got a couple earnings reports after hours here. We got Snow. Snow is really trading up. I didn't look at the numbers. I assume that they crushed it. They beat on product revenue. They beat on diluted EPS. Just looking at these numbers. They guided higher on fiscal year revenue. They guided higher, and a little bit higher on the second quarter product revenue as well. So looks like a decent report from Snow. Not necessarily knock your socks off, but decent. Oh, we got Zoom out. What's Zoom doing? Zoom also trading up a little bit. Okay. Snowflake gains 7% after lifting 2026 product sales view. Okay. From Greg here at 12:45 on YouTube, I said you can make a lot of money in these markets if you hold your winners, not looking for 20 cents on trades. And then just like that, the Q is making a new high, and then whoosh. Yep. Yep. Whoosh. That certainly happened. And the other part about that actually was when I was on with JR today, he brought it up first. We both really started talking about the bond market. Like, watch this bond market. That could really be the canary in the coal mine. And then within 15 minutes of us getting off the podcast thing, we got the Treasury move that just wrecked the market. So that's definitely the thing to watch right now. Over in the YouTube from Robert, can you explain the bond auction fundamentally? When they are selling for a higher percentage, it means negative for the market and vice versa. Yeah, sure. So I'm not an expert in this, but I can certainly give you an overview. So the federal government needs to raise money in order to continue to do their operations. They do that through debt. And that debt comes in the form of these treasury auctions that we see happen. And basically it's supply and demand. So they have a certain amount of debt that they're looking to sell. They think that they can sell it at a certain interest rate, right? Because the incentive of a buyer of debt is the rate of return, and that rate of return is the interest rate. And if people aren't willing to buy the amount that the government is looking to sell at a certain interest rate, then the government needs to, it's just a marketplace, right? Needs to sell at a higher interest rate because that will drum up more demand. Um, People are going to have more demand for a bond at 5% than they would at 2%, everything else held equal, right? So if they can't get it done at, I don't remember exactly what the numbers were on this auction today, but if they can't get it done at the price that they want, then they had to raise that price just to be able to to get it done. And that's the concern. The concern, the broader picture concern on the market that's kind of been this way ever since these April lows, though the market rally here has been so insane that people are moving away from the conversation a little bit. But if you remember, in April, the conversation was, are tariffs, amongst a couple other things, basically ending what people have been referencing as U.S. exceptionalism as a whole, right? The dollar is the world's reserve currency. U.S. Treasury bonds have always been considered to be like the only risk-less asset because it's backed by the faith and the balance sheet and the GDP of the strongest economy in the history of the world, which is the United States. And with the policy changes that were made, we have seen, especially foreign investment in the U.S. decline dramatically. Was it in Pat's note this morning that showed? I saw somewhere. I don't remember if it was in Pat's note or just in my own research. I saw somewhere a chart of foreign government buying of U.S. debt this morning, and you can just kind of see, I guess it was not from Pat's note, I saw it somewhere else. You can kind of just, whatever the look back was on that, however many years, you see that there's basically just always been a steady supply of foreigners, foreign governments primarily, buying U.S. debt. A couple exceptions on that chart, and again, I'm going totally off of memory, was I think in 2008, the buying dried up and there was some degree of net selling, and that's probably because there was a global financial crisis. I think in 2000, the chart showed the same thing, that there was selling, actually net selling by foreign governments and foreigners on U.S. debt. And now, right? That's a hell of a camp to be involved with, right? Again, assuming that my memory is correct, the only times in recent history where we've seen net selling by foreigners of U.S. government debt is in the tech bubble implosion, in the financial crisis, and now. So that's the big conversation: is this the end of U.S. exceptionalism as we have known it for a very long time, based on some of the policies? I don't have the answer to that question. I don't know, but the markets can and will tell us over time. And it's been incredible the way that the stock market has rebounded, but the Treasury market, while it did have a rebound off those April lows, we saw very quickly that this worked its way back down to those lows. I think also there's a lot of forced selling in Treasuries from, and I don't look at this data as much because I'm a stock trader. I pay attention to the systematic data in the equity market because that's what really impacts me. But I think that there's a lot of systematic selling that is also ongoing in the bond market right now at the same time as we're having systematic buying in the equity market. So that's just an extra piece of information. Obviously, when you're talking about the U.S. Treasury market, it is insanely big, significantly larger than the U.S. equity market actually is. But that's the question. As we see that the dollar's been more stable, not working its way back down fully, but got hit today. So it's really a matter of bonds. And then the other thing is when it comes to higher interest rates, it just means that the servicing of that U.S. debt costs even more money. And I think. So please, again, I'm kind of going off memory on data, so feel free to fact check me or whatever. I think that the U.S. servicing the U.S. debt, basically paying interest on it, is the second highest expense on the United States government's balance sheet after Social Security, I think. So higher interest rates is a problem just because that means that we're going to have to spend even more money. But then one of the other potential influencing factors, and this is not me making a political statement, this is just some of the data that I've seen, and I'm sure that there's other data out there that might say the opposite, but the tax cuts are really interesting because on the surface of it should really be a boom to stocks. However, there are a lot of research reports that are coming out that basically are saying that the Trump tax cuts, Trump 2.0 tax cuts, which are even more dramatic than Trump 1.0 tax cuts, is going to also massively increase the debt. I think I saw from some analyst, I don't remember who, $3 trillion have increased in debt over the course of the next, I don't remember how many years, 10 years, something like that. Sorry, just 1 second here. Yeah, so I mean, all that's adding up, and it's potentially kind of creating a bit of a crisis here. I mean, this is something that's been talked about for my entire adulthood, basically, is um, the, the debt of the U.S. government, but it seems like it's starting to come to a head right now. So yeah, we'll see what happens. Question on the Qs, also here in the YouTube from Robert. Question on the Qs: would you be confident to start buying QQQ at the open, right at the open at 516.50? It's not any major level, however, that major NQ London session buying level. So you're talking about the open today? I mean, I haven't been doing that. That's been some chatter in the VTF about like what I have been doing has been covering my shorts into these gap downs more so than aggressively buying them. And there's been some chatter about like, well, why aren't we just buying every gap down like this? We know there's this never-ending bid, and even look what happened on Monday, right? When Moody's downgraded the debt, and we just had the most insane off the open rally like ever. And then today seemed like it was a borderline repeat of that. For me, I get it. I feel like on the big picture, even though we now have consolidated this week and the ADMA has caught up, I still feel like it's chasing to me. I don't want to buy these price points. I made a point in yesterday's afternoon meeting and then again in the morning meeting today that I think is an interesting one about time right now. What does time mean to us in the market? From a technical analysis perspective, time is a bull's friend. The market got extended, stretched from these moving averages. Short-term tactical was in the red like 5 days in a row. We were over $10 of extension from the ADMA and the SPYs and the Qs for 5-6 days in a row. So all that was ongoing, and going sideways here for this entire week is bullish because it lets those moving averages catch up. It satisfies that short-term tactical. It potentially brings in new buyers at the equilibrium zone as equilibrium catches up. But I think from a market dynamic perspective, time is not so bullish. I'm not going to say time is bearish from a dynamics perspective. I'm going to say time is not so bullish. The call skew gamma data that I've seen indicates that if we can break highs, like break out of this consolidation, really with the SPYs at the S&P above 6,000, that could create another leg of a squeeze higher. And that's, as we know, that after this week, CTA buying should drop off. So my concern as someone who has not been buying those small dips and someone who's been trying to short this market, my concern has been, well, corporate buybacks and CTAs in and of themselves might be enough to push the market up to 6,000. And then if we can push the market up to 6,000, then you get gamma that takes over and creates a whole new leg up on the market. But if we get through this week, a lot of that squeeze potential drops off. A lot of that negative gamma above 6,000 doesn't completely drop off, but a lot of it disappears. And if we can get through this week, then the CTA bid is gone also. So in that regards, I'm not going to say from a market dynamic perspective, I'm not going to say that time is bearish, but I'm going to say that as time goes on here, those market dynamics are becoming increasingly less bullish. And then at a certain point, if you could combine some bad economic numbers or whatever when we get into the June-July period that can increase volatility, all of a sudden that could actually trigger a real wave of the VIX moving back into the mid-20s or maybe even more. The equity market selling down, retesting that key 570. So I've been, because of that more bigger picture thought process, and I always kind of start bigger picture and then work my way down, I've been very hesitant to buy these gap downs, even though they've been consistently working, because I think that we're getting closer and closer to a period of time here where they're not going to. But we'll see. With that said, now reading the rest of your comment, combining that with the opening extension of the downside, scalping back to the EMAs, that I like. If you want to look for an opening scalp because of the downside extension, just back to the equilibrium area as like a cuter day trade, that I definitely like. I've been just kind of not doing it. Managing my swings has been a big focus. I just have a lot of exposure on right now. But that's a trade that I very, very much like always on big gaps, is unless it's showing itself as like a real breakaway gap, which has the potential to gap and go at a higher probability. I like the idea of looking for a low to go long off of on big gap downs just for a bounce back to equilibrium. And then that bounce back to equilibrium can sometimes then be shortable, right? Or sometimes I'm like, I'm just going to not try to do that buy idea, but I think that the market can go down. So I'm going to be patient. I don't want to chase a large gap down, but I'll be patient if we can price correct or time correct in the beginning of the day and the moving averages catch up. I like that as a short. And that could be a bigger picture short potentially also, which means larger reward. Back on the bond. So it also means the longer bonds, like the 15 to 20 year, might be more fundamentally important and heavy for the market than the 5 to 10 year. Yeah. So you have a yield curve there, and the yield curve matters. And those longer duration bonds tend to be riskier because of the amount of time that is behind them. So seeing a lack of demand on longer term bonds is problematic, or if everybody's rushing to buy the short end and no one wants to buy the long end, can be problematic. Next comment here is from Daddy Trade. The snag January 2026 at the money calls on the TLT. January 2026, okay. Small 530 at the money put, May 30th at the money put as a hedge in case they flush it out. But I think Powell chickens out and cuts, but I don't think he should. Okay, I mean, we'll see what happens. I mean, that's definitely something I have in the back of my mind as like if I'm leaning on being bearish on the equity market because of what I'm seeing in the bond market, I certainly have in the back of my mind that at a certain point on a bond market move, I think Powell steps in with something. Probably more likely bond buying than an interest rate reduction, but we'll see. We'll see what the timing is on that as well. All right, looks like I got through everything in the VTF and in the YouTube, so I'm going to wrap it up there. I hope everybody had a great day. I will see you all tomorrow.